Hello, and welcome to Shrimpy, your favorite source for cryptocurrency information. My name is Jade, and today we'll learn about portfolio stop losses. A portfolio stop loss is an advanced strategy that is designed to limit an investor's loss when the market goes down. When a specific portfolio value point is met, the stop loss is triggered and each of the open positions in a portfolio is closed. This is a stark contrast to ordinary stop loss order types, which day traders use to limit losses on specific positions and assets rather than entire portfolios. Due to the validity of the cryptocurrency market, portfolio stop losses are becoming a fundamental part of the trading process for long-term profitability. Let's say your total portfolio is valued at $2,000 and you set your stop loss for $1,700. If your total portfolio went below the $1,700 mark, your stop loss would trigger selling your assets for a stablecoin of your choice. Now, imagine that an unexpected black swan event, flash crash, or any other unordinary market deviation devastates the crypto market in a short time span. A pullback between 30 and 40% would not only be terribly difficult to manage, but it could also potentially occur during a time when you are not online or do not have access to your account. To protect themselves and thrive, investors can add a stop loss to their portfolio and be prepared for such a situation. Following our example, investors achieve two major goals by setting a portfolio stop loss: limit losses and liquidate assets on time. At $1,700, the maximally incurred loss would be 15%. Taking into account a 40% crash, it would be possible to buy back and increase the size of one's portfolio by 25%. Or, if the market remained unstable beyond the initial crash, having money on hand would give us enough time to create a strategy and think about our next steps. Since we have automated the entire process, we have also saved an unquantifiable amount of stress. By setting our expectations for losses ahead of time, we have already decided how to act when it comes down to the worst. Considering that most investors would be forced to actively monitor the market and hatch a plan while panicking, having an active stop loss is more than enviable. A portfolio stop loss represents a crucial tool in effective risk management. It saves time and money while also teaching you how to be a better investor by building discipline. But not all stop losses are designed to deal with bearish markets. Some can also be used to establish thresholds at which we wish to realize our gains. For example, after a productive technical analysis session, we have concluded that a volatile DeFi token is able to reach a three-figure price level. This token currently trades at around $50, but rises up and down in value so fast that it might as well retrace after reaching our price target. Everyone naturally wishes to get the most out of their investment, but if we want to invest like a true professional, we have to find a way to both secure profits and allow us to sell higher up if the asset suddenly explodes in value. Another aspect to keep in mind is that if we manage this trade without a strategy, we might let our emotions control us to the point of clinging on to the token and its performance. What if the asset retraces but never recovers and reaches its all-time highs in the near future? If we set a portfolio stop loss threshold at $100, what happens is that even if the threshold is reached, we will not immediately sell. Instead, we can decide to wait and see what happens next and potentially sell at a higher price point. Let's say the token reaches $200. We can manually sell and double our profits. But if the token retraces back to $100, the stop loss will automatically sell and realize your profits as planned. Again, it is worth pointing out that the most lucrative aspect of a portfolio stop loss is its ability to automate tasks that require manual execution. We might not always be able to manage a portfolio due to time constraints. Moreover, investors expose themselves to high risk by acting only when it is necessary to do so. There's more than one type of stop loss, but let's not get ahead of ourselves too fast. Before continuing with the video, let's test your current understanding of this advanced strategy first. We'll give you a total of 3 questions, And if you answer all of them correctly, you can consider yourself a master of risk management. And now it's time for the quiz. Question number 1. What is a portfolio stop loss? Is it A, an advanced investment strategy that limits losses for a portfolio? B, an order type that limits losses on a trading position? Or C, a tool that only protects investors during a flash crash? The correct answer is A. A portfolio stop loss is an advanced investment strategy that limits losses for a portfolio. Question number 2. What is the difference between portfolio stop losses and traditional stop losses? Is it A, traditional stop losses are not executed automatically? B, portfolio stop losses protect an entire portfolio while traditional stop losses protect individual orders and positions? Or C, both work the same? The correct answer is B. Portfolio stop losses protect an entire portfolio, while traditional stop losses protect individual orders and positions. And our third and final question. Does a portfolio stop loss only limit losses, or can it also secure profits? Is the correct answer A, yes, it can do both? B, no, it only protects against losses? Or C, it neither secures profits nor protects against losses? The correct answer is A, it can do both. In case you failed to answer some of the questions correctly, feel free to watch our video again or read a more detailed article on portfolio stop losses on the Shrimpy Academy. All right, let's get back to the topic at hand and learn more. There are 3 types of stop losses. A complete portfolio stop loss, when executed, closes the entire portfolio at the selected value level. This is usually done when one believes the market will reverse completely once it reaches a certain point. A partial portfolio stop loss means the portfolio is only partially closed. You can set a percentage of the portfolio that will close. This comes in handy if you wish to place multiple stop losses at different levels rather than just one. The trailing stop loss moves along with the price of an asset if it moves in your favor and remains fixed if it does not. This is a great method of securing profits at higher price levels. The best part of a stop loss is it is free to implement. It also allows decision-making to be free from emotional influences. A stop loss does have its drawbacks as well. A short-term fluctuation in price could activate the stop loss. The key is picking a stop loss percentage that allows a portfolio to fluctuate day to day while also preventing as much loss as possible. Overall, the stop loss is a simple tool that is underutilized. If you haven't yet, please make sure to like and subscribe down below so you don't miss out on the next video. Thank you so much.